Real estate has been all over the place. Many people are starting to signal the fact that interest rates are going to rise continually, and that will have an impact on the prices of assets simply because it puts more restriction on those and their ability to borrow. But there's something going on here. The first thing I need to talk about is, how does real estate and Beyonce come together? What is the link there? I'll show you that. The second thing is the direction of assets. I'm going to look at the Japan scenario as one that we must pay attention to. There's a lot going on. Let's begin. Here it is. Beyonce launches 100,000, I can't believe I'm saying this, $100,000 a night Dubai Resorts luxury bet. So what we're talking about is the new Atlantis that's going up in Dubai. This hotel here for the rich and famous, for the glitz and the glam, for those who want a little bit more than what is necessary. This is one hotel. Now they are actually hiring Beyonce at $24 million for one night's performance. They're going to have the fireworks and the displays and everything. The last time this kind of thing happened was actually the previous Atlantis that was there. This is the second one. Opened a year before the market crash. So some people are saying this signals a top, but there's something going on in Dubai now that is very different than back in 2009. And they make those comparisons in this article if you're interested in checking it out. Basically what they're saying is the situation is not what it once was. It's not just all fallacy. We do have more strength. We have buyers coming from everywhere, including a lot of them recently from Russia. The money is pouring in. You've got the crypto guys are moving in. All of these things are making it very friendly, business friendly, and of course investor friendly to move there, set up shop, set up the corporation, and even live there full time. And what they're saying is it's not so transient anymore. People who live in Dubai will tell you they're there for a few years, it's great and all, fun, but then they decide to move out at a later date. Maybe that's not happening. A lot of people are staying and extending their stays longer. So this is Dubai. This is one that we need to watch because it was really a marker or a bellwether back in 2008 into 2009 of the real estate bubble. So that's one to watch as of right now, looking really strong. Milan luxury real estate booms as bankers leave London for Italy. They want to get out of there. They want something more reasonably priced. Maybe they don't like the fact that you can't wear a nice watch around. You're going to get your arm lopped off. This is a very different scenario than what had happened over the years. Italy did not grow in real estate terms, did not grow at the rate of a lot of the other countries in Europe, the major cities in Europe. So Milan looks cheaper by extension. When you see the actual prices, the cost of living, it is much lower. And of course, you're within the EU, so they're able to take advantage of that for work purposes. Maybe they've got a branch for the bank that they work at and they can move to that new city, and that's the way it goes. So that's one place. Didn't see a particular rise before, and now it's doing very well in comparison to the others. This is kind of like, in the way you want to look at it, it's kind of like what's happening in the US. And you see that people are moving out of one state, they're moving into another just because of the cost factor. That's very important. We shouldn't overlook that, okay? Here we have it, seeing other cities like Miami might see continued appreciation in 2023. South Florida real estate is unique from other US markets in that we continue to see high migration domestically and internationally. Of course, interest rates could play a role in this in the coming months, but you see it right here for yourself. That's one place that there's just been so much building, the mass building, and at the same time, we have people taking on way too much debt, businesses taking on debt. Those corporations finance that, of course, with a growing level of expense. Okay, as the interest rates rise, it's becoming more expensive, but they're doing it anyway. So we'll see what happens in the coming weeks. I think this is going to be a concern, although you could see that, I believe I have the chart for you, that mortgage rates have declined from their peak. Existing home sales fell for the 11th consecutive month in December, hitting the slowest pace since November of 2010. That's nationally. You could look at that. Certain areas, like I just showed you, Miami, are doing better than ever. Dubai, doing better than ever. It just depends on where you look. So I just wanted to highlight that for a moment, but to show you, home sales down. Why? Because they're kind of waiting. A lot of people are just saying, well, why not just wait? So it's becoming more of a buyer's market. However, if you take the simple ratio of the median salary or the median household income and compare that to the median price of a home, it's completely out of whack. You compare that to Canada, you compare that New Zealand, Australia, many of these other places, the US looks cheap by comparison. So I posted about that on Twitter. And ultimately, it's like we need to look at what the top 10% of people are really doing with their money to get an idea of where we're at. If we focus on, each individual group, and it's just going to get all convoluted, but certainly where the money is at, as they show you here in this chart, 10% of the US population owns 84% now, that was 84 in this chart, now 88% of all stocks held by households. So you know that. Almost the entire majority held by the top 10%. I'm sure if you go to the top 5%, top 2%, 1%, it gets even more extreme. You realize a very small percentage of people own all of it. That's the real estate, that's the stocks, that's any asset at all. So we need to focus on those groups of people. Yes, there could be instances where a bunch of people, holding $50 worth of a particular stock can make change because everybody comes together and, all their 7 shares of Amazon make a big difference. But, you got to look at it realistically. And when we're looking at macro trends, when we're trying to expand on this, should be, we gotta be clear about that. That's all I'm saying. U.S. existing home sales month over month and year over year, basically collapsing. We haven't seen this before, worse than what was going on in the financial crisis, housing crisis, if you can believe it or not. Now, that doesn't mean the prices are collapsing. That just means the home sales are collapsing. Why? Because we haven't seen a pace at which mortgage rates have increased like this. That is turning around just slightly right now, just slightly. So I'm interested to see where that goes. You can look at this and it's just showing you the total existing home sales down to levels we haven't seen since the housing crisis as well. This is showing us that we have come down significantly from the peak in mortgage rates, above 7%, now down to just under 6%. This is a factor of, your credit score and all these other things, the different bank or lender that you're borrowing from, but they have come down. That's the point here. That's what I wanted to make you aware of. And that has resulted in some people jumping in and saying, okay, I better get in right now. And so they're doing that. We see that in the details, looking at in my opinion, the inventory being very important, but can be convoluted. So the month supply has increased here a little bit. And why? Why has that been the case? Well, as soon as interest rates rise, you see that being the trend. This is obvious. This is expected. But for a lot of people, they didn't understand what happened. Look, it's coming from a super low level. We know that. So any increase is going to look like a large one. But at the same time, where are the people that are not looking at the obvious fact, in my opinion, is that as soon as there was the thought that, oh, you know what, interest rates don't have much of an impact. As long as there's not enough homes available, prices will continue to rise. But what about the fact that, a simple change, a small change in interest rates, and that started to progress over this last year, 2022, made such a direct impact on the housing prices and availability right away that, if you looked at it, things were just going crazy. Oh, suddenly it was 1.2, then it was 1.3, then it was 1.4. The $1 million just, it doesn't matter. It doesn't matter what the price is. Let's just bid on it. Multiple bidders everywhere. The things were going so frantic. Suddenly they changed that in 2022, makes a huge difference, and now inventory starts building. So obviously these are correlated. It's not as if millions of people are just coming in and needing to buy homes immediately. There's a lot of speculation at play, and we need to be aware of that. So let me break this down for you. Governments and central banks often create stimulus in order to boost economic growth and combat recessions. This can take the form of monetary policy, such as interest rate cuts or quantitative easing, as well as fiscal policy, such as government spending or tax cuts. While these measures can have a positive impact in the short term, they also create risks for the long term. One example of this is Japan, where the government and central bank have been implementing stimulus measures for decades in an effort to boost economic growth. Despite these efforts, Japan's economy has struggled to recover recover, and its real estate market has not surpassed its previous high. This is partly due to the fact that these stimulus measures have led up to a buildup in debt and an asset bubble, which can make it more difficult for the economy to recover in the long run. Also, the low interest rate environment created by the stimulus measures can make it difficult for savers and investors to earn a decent return on their money, which can also slow down economic growth. In summary, while the governments and central banks can use stimulus to boost economic growth in the short term, it also creates risks in the long term, such as a buildup of debt, asset bubbles, and difficulties for savers and investors to earn returns on their money. The example of Japan illustrates how these risks can materialize and can make it difficult for the economy to recover. So let's look into this next aspect right here. And if a deeper recession comes, the federal government may not do much spending to cushion the blow, at least until the debt ceiling is raised. I've covered this before, talked about the debt ceiling. It is obviously quite nonsense that the government will not fund the government. We know that they're going to fund themselves. It's like, hey, do you want to just give up your paycheck at work? No, it's not going to happen. But anyway, the point here is that they need to spend more money. In this case, to stimulate, they have to spend more money. Where they get that from? Well, they're kind of arguing about that right at this moment. The process of raising the debt ceiling looks almost certain to be a gnarly political brawl that could tank markets. Remember, the S&P 500 fell 15% in the 2011 debt ceiling brouhaha. No, I don't think that's going to happen this time around. The government knows that they have to spend more and more and more, so I wouldn't be concerned. But we got to understand that we are going in this time frame right now where recession is always on the table. A lot of that talk. Oh no, recession. They've got to, for the political sake, boost this up. Where will that stimulus come from? Quantitative easing and maybe reduced interest rates? Or it's going to be some sort of package that they need to push through. I wanted to also show you this because, by the way, that signals what happens in all markets. When we have this direct stimulation, you see the result of that in risk assets in particular, okay, stocks, but it also flows into real estate. I mean, it depends. In this example, I'm just showing you platinum for a moment here. A lot of facts about platinum. Platinum gets ignored, but it is a precious metal, and I wanted to mention it. Platinum suppliers, South Africa is by far the world's leading platinum producing country, with Russia the second top producer. South Africa's output is more than 5 times that of Russia. Zimbabwe is the third leading producer. These two are massive in that they are providing platinum. Platinum is used in so many different products, okay? All sorts of technology. It is extremely important, not just catalytic converters, but you just look at it's in there, okay? A little bit of platinum somehow makes its way into, such important technology, okay? Look at the two countries. What do we know about South Africa and Russia? Well, they're both part of the BRICS. Do you see an important aspect here? Yes. These two countries hold the key in this regard of something that is critical to basically the whole world. Not to mention the rare earths out of China and so on, which I will cover in another video. I just wanted to make mention of that. It's forgotten, platinum is forgotten. Look at the two countries producing the most of it. Lithium's next big risk is grand supply plans falling short. And you could just look at it. I think lithium's a big one because there's a lot of hope that all these electric cars are going to be built. We're going to be able to charge these electric cars. It's not going to have any impact on the electrical grid whatsoever, even though California, when they were having some power problems, they basically said nobody's allowed to charge their electric car. I find it very weird, but look at everything that has a battery in it today. I mean, everything, and even cheap devices too. It's not just expensive things like cars. We look at them all the way down the line. Cheap electronics may contain a lithium-ion battery in it. That's just one thing, but lithium's finding its way into all kinds of things. This is another one that we have to watch because if the price spikes, that means the consumer products spike as well. So watch these trends carefully. How do you watch them? Oh, it's pretty obvious. All you gotta do is hit that subscribe button. But anyway, I wanted to show you something. I talked about this at the beginning, and I want to thank you for still being here at the end. The Bank of Japan. This is the central bank of Japan, and I've been talking about this for a long time. This one, I don't have the words. I'm gonna try to get into it. Let me show you something. Okay, here we go. Bank of Japan bought the equivalent of $550 billion worth of their bonds. 14% of Japan's GDP was purchased. Think about what they're doing here. They said if it continues at this pace, they would literally have bought the entire market in a relatively short span. The entire market, every single thing, everything. There's no market left. In fact, they own more than half right now. More than half of the entire market. What does that signal? Well, you might say, things can turn around and things could be okay and we don't have to worry about this. This is not a concern. You can print an unlimited amount of money and it does not have a risk. Assets always go back to the previous level and beyond. So I pulled up this chart here just to give you an idea. This is just one, randomly picked up, and that happens to be residential property prices for Japan. And you see that big peak in the middle there? Yes, that was what we looked at in early 1990s, where the housing prices peaked. Right around the same time, of course, their stock market did as well. We have yet to reach that crazy level. In fact, we are back at these levels from, hard to tell exactly, but let's just say the late 80s. Late 80s. How would you like it if you bought into some crazy real estate that you thought was going to be a great idea, and it's decades and decades later, and it's still not where it was? Now, that's an example. I'm sure there are many buildings, there are many, properties that you could have bought 10 years ago and now they're higher today. But in general, when we look at that, we have to understand that things don't always move in this one direction. We have to be aware, we have to be concerned, and then we have to look at where the central banks move their money, because they will devalue the currency. So we would rather be in assets than the currency itself. Japan, unusual circumstance that, you look at what they had done, and basically the world kind of uses it as a temporary in and out trade, but the yen had been really devalued against the US dollar, showing you that people don't really care about the yen. It's ultimately just being used as a place kind of to dump money temporarily. There's still so much to that. Maybe I can get into that in a future episode. But what I wanted to show you here was watch carefully what the central banks do and you will be more informed. I'll see you on the next one. Take care.